Good morning, everybody. Today we're doing a financial reporting update, getting ready for 31 December 2017. So it's this time of year where we're starting to think about the preparation of either our half-year financial reports at 31 December or maybe our full-year financial reports if we've got a 31 December year end. So in this webinar today, we'll be looking at the roles of directors, which I think whenever we talk about financial reporting, preparation of financial statements, we have to start with a very important role of directors. Then we'll look at the new mandatory accounting standards for 31 December 2017. And the good news is for 31 December 2017, we only have 4 fairly small new mandatory accounting standards or amendments to accounting standards. As you know, 1 January 2018 is the application date for IFRS 9 and IFRS 15, and then 1 January 2019 IFRS 16, and for not-for-profits AASB 1058 and or AASB 15. So this, I suppose, is the last annual accounting update that there won't be significant changes because we know the next wave is going to hit us come 1 January 2018. Then in section 3, I'll talk about the preparation of general purpose financial statements for significant global entities, and that's a big change. I will talk also about deferred tax accounting for indefinite life intangible assets, and again the IFRIC has issued a clarification to remove diversity in practice. An issue that we've identified fairly recently is deferred tax accounting for research and development incentives, so I'll try and explain that. I'll also briefly touch on the change in tax rate that went through Parliament in May this year for certain companies. And then towards the end of the webinar, I'll touch on the triple threat accounting standards as well as AASB 1058 and the transitioning to those triple threat accounting standards. And lastly, finish with the disclosure initiative. So that's really the outline of the session. As always, remember this is training, it's not specific to your situation, and if you need any advice, please contact your BDO contact person or the IFRS advisory team. So let's start the webinar and start with the role of directors. Now I just want to emphasize that even though, and I think this is a really important note, that even though directors do not need to be accounting experts, they should seek explanation and advice supporting the accounting treatment chosen, and where appropriate, challenge the accounting estimates and treatments applied in the financial report. So directors see the first draft of the financial report and they should think, are we happy with the accounting treatment chosen? Are we happy with the accounting estimates? And challenge those and have a real robust discussion with the CFO, with the CEO around the financial statements. And I think it's really important in the second bullet point that directors should particularly seek advice in a situation where the presentation in the financial statements do not line up with how they understand the substance of an agreement or a transaction. So directors know about a lot of transactions, or should know about the transactions and the agreements in place, and consider whether how they understand the transactions and agreements is that's how it's been portrayed, presented, disclosed in the financial statements. So really important that directors have this discussion with management way before that the auditors get involved. So directors are responsible for the preparation of financial statements. Now, ASIC has issued 2 information sheets to assist directors. The first one, information sheet 183, are around directors and financial reporting, And the next one, information sheet 203, is around impairment of non-financial assets. Just a question, could you please give me an indication whether you can hear me? Everybody happy that they can hear me? I've tested the sound, you should be able to hear you. I've got some concerns. Everybody happy? Could you please? All right, it looks like that's fine. Thank you very much. Thank you very much. So if you've got any concerns during the presentations, we've got somebody monitoring the question bar. So if you pop a question or a comment or IT difficulty in there, she would be able to respond to that. So thank you very much. I get so focused on presentation, I don't always look at the question bar. So the role of directors is the first part. The second part that I want to look at is the new mandatory accounting standards for 31 December 2017. And as I said, only 4, and all of them are amending standards. So nothing brand new accounting standard. The brand new ones, IFRS 9, 15, 16 and AASB 1058, come into play over the next 2 years. So we look at the 4 amending standards, and they are amending accounting standards that have already been issued a number of years ago. I'll start with the recognition of deferred tax assets for unrealized losses. I'll also look at the disclosure initiative. There's an amendment to the cash flow statement. I'll look at a recoverable amount of non-cash generating specialized assets, and that is specifically for not-for-profit entities. And there are further annual improvements, which I'll end this section with. So if we start with the recognition of deferred tax assets for unrealized losses, in this particular amendment, there are 4 changes. And the first one, it says that where the fair value of a fixed rate debt instrument that is going to be held to maturity has decreased because of an increase in market interest rates, the standard now clarifies that a deferred tax asset must be recognized for the deductible temporary difference that arises between the fair value and the tax base, even though the investment itself is not deemed to be impaired. So that's a mouthful. So I thought, let's look at an example to try and illustrate that. So in this example, we've said, let's say entity A purchases a debt instrument on the 1st of January, year 17, with the following terms. So the face value is $1,000. It's repayable in 5 years' time. The interest rate is 2%, payable annually in arrears. And for our example, let's say the effective interest rate is also 2%. So our nominal interest rate 2%, effective interest rate also 2%. The instrument is measured at fair value in the financial statements in compliance with IAS 39. Or AASB 139, and let's say when we apply the tax rules, the tax base of this instrument is 1,000. So the fair value of the instrument at the 31st of December is $918. The reason for that change in the fair value is because there's been a change in the market interest rates, and the market interest rates are now 5%. So the fair value of our instrument has decreased because we only receive or earn interest at 2%. However, in the market, on a similar instrument, you can earn 5% interest revenue or interest income. So the fair value has gone down. Now, entity A will hold the instrument to maturity, and therefore they will collect all the cash flows. They will collect the $1,000 in another 3 years' time. So therefore, this instrument is not impaired. There's no impairment loss. So the instrument is not impaired, but there is a change in the fair value. The question is, should a deferred tax asset be recognized in respect of that decrease in the fair value of the instrument? So some people would have said, and there's been diversity in practice, should we recognize it or not? The asset is not impaired. I am going to get the 1,000. What do we do? So what they've clarified is you will recognize a deferred tax asset if it meets all the other recognition criteria, as in there will be future taxable income against which to offset this loss. So as soon as the fair value falls below cost, we've got a deductible temporary difference. The carrying amount is $918, that's a fair value. The tax base is $1,000. You've got a deductible temporary difference of 82. You have to recognize a deferred tax asset of the 82 times, let's say, the 30% in Australia. So this is really clarifying a practical problem. So that's the first example. The second change is deductible temporary differences must be compared to taxable profits of the same type. Now, what they mean by that, you could have taxable profits that are either capital or revenue profits. And now if we want to make sure that there's enough taxable profits in future to realize this DTA, they say compare apples with apples. Compare capital profits with capital profits and compare revenue profits with revenue profits. So that's the next change. Again, there's been divergence in practice and therefore a reason to amend the standard. As always, let's look at an example to illustrate this change. So let's say company B holds two buildings, building X and Y. Now building X has a carrying amount of $1 million and it's held at fair value, and the tax base is $1.5 million. If you look at building Y, it's the opposite. It's got a carrying amount of $1.5 million and the tax base is $1 million. Now the tax rate is 30% and company B is planning to recover the assets through sale, both of them. So should company B recognize a deferred tax asset on building X? So just looking at the facts, when you do a deferred tax calculation, you look at the carrying amount of an asset, you compare it with the tax base of the asset. If there's a difference, a temporary difference, that temporary difference is either taxable or deductible. And therefore, we have to decide whether we recognize a deferred tax liability or deferred tax asset. Now, in this situation, on building Y, we would recognize a deferred tax liability. On building X, the question is, should we recognize a deferred tax asset? Because on deferred tax assets, we're always concerned, are there future taxable profits where this deduction would be able to reverse? So that's the question. The solution is yes. Company B will be able to utilize the future capital profits expected from building Y to offset the capital losses on building X, and therefore the deferred tax asset should be recognized. So to make this assessment, we're only looking at capital profits and capital losses. And the fact that we know there's going to be a capital profit potentially from building Y means we can recognize a DTA in respect of the capital losses on building X. So change number 3. When comparing deductible temporary differences against the amount of future taxable profits available, we would exclude tax deductions resulting from the reversal of deductible temporary differences. So the calculation of future taxable profits must exclude tax deductions resulting from the reversal of this deductible temporary difference. Again, that's the change. What does it mean in practice? A bit of background. Currently, AASB 112 income taxes in paragraph 24 states that a deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable that taxable profit will be available against which these deductible temporary differences can be utilized. Now the question is, how do we determine the amount of taxable profits available? Is it net taxable profits or Is it net taxable profits, but we're adding back the effects of the deductible temporary difference we are comparing it to? So, you know, what do we compare with each other to make this assessment in paragraph 24? Now, what they've done is they've, through this amending standard, added a new paragraph, paragraph 29A1, and they say you compare to net taxable profits, but you add back the effects of the deductible temporary difference we are comparing to or we are analyzing. So it really shows the extent to which the future taxable profit is sufficient for the entity to deduct the amounts resulting from the reversal of these deductible temporary differences. So let's look at an example to illustrate. Let's say on 30 June 2017, ABC Limited has $15,000 deductible temporary differences in respect of a $50,000 employee benefit provision, which are expected to reverse during the 2018 financial year. The net taxable income is projected to be nil in the 2018 financial year, and that is after we've deducted for tax purposes the $15,000 employee benefit provision that we've paid. So the year end is 30 June. The question is, should ABC Limited recognize a DTA at 30 June 2017 for this $15,000 employee benefit provision? So do we have enough taxable profits in future that we could be able to realize this deductible temporary difference? And the solution is yes, because you're not comparing the DTA or the deductible temporary difference with your estimated net taxable profit of nil. You are adding back the employee benefit provision that will be paid in 2018, the $15,000, and therefore now you have enough taxable profits in order to recognize that DTA. So ABC Limited estimates that it is probable that the $15,000 taxable profits before deducting this provision paid will be available to set off against the $15,000 DTA. So another clarification on when we make this assessment around the recognition of deferred tax assets, what do we compare it with? Are we comparing apples with apples? The fourth and the final change in this amending standard is around the estimate of future taxable profits can include the recovery of certain assets at amounts more than their carrying amount, if there is enough evidence that it is probable, more likely than not, that the entity will recover the asset for more than its carrying amount. Now, when would this happen? Example of this could include property measured using the cost model, and there has been an external valuation, and we know the external valuation is exceeding the cost, or we've got a fixed rate debt instrument that we know we're going to hold to maturity. Now again, how does this translate into a practical example? Let's say company XYZ holds 2 buildings. So it's similar to example 2, but please note the slight differences. So company XYZ holds 2 buildings. Building A has a carrying amount of $1 million. It is held at cost, and it's been impaired. And then the tax base is $1.5 million. So for tax purposes, we'll still be able to deduct another $1.5 million going forward. However, the carrying amount is $1 million. What about building B? Now, building B, we have a carrying amount of $1 million. So it's also at $1 million, it's held at cost. The tax base is $1 million, and the fair value of this building is actually $1.5 million. It's carried at cost, but we know for some reason we've done a fair value of this building, and it's $1.5 million. So the tax rate is 30%, and company XYZ is planning to recover the assets through sale. So the question here is, should company XYZ recognize a deferred tax, I beg your pardon, on the building on building A. So should we recognize a deferred tax asset on building A? Now, if you look at building B, the carrying amount and the tax base is the same. There's no temporary difference if you just look at the carrying amount, the tax base. However, building A, we have a deductible temporary difference, so we should consider whether we should recognize a deferred tax asset in that situation. So what they've clarified in the standard is that you could, if you've got enough audit evidence and if it's probable, you could recognize a DTA, because you would say company XYZ will be able to utilize the future capital profits expected from building B to offset the capital losses on building A. Therefore, the deferred tax asset should be recognized. Now, this is an interesting concept, because if we go back to the previous slide, we've not booked a deferred tax liability on building B because we don't have a temporary difference, carrying amount equal tax base. However, when we make an assessment for the purposes of the DTA on building A, we can take into account the fact that we expect there to be future taxable profits resulting from building B. We think it's probable, and therefore we can recognize that DTA. So you can see here that this amending standard absolutely focuses on when can you recognize a deferred tax asset, and specifically when do we think and how do you do the calculations of whether we've got enough future taxable profits in order to justify the recognition of deferred tax assets. So if you are thinking about whether I should recognize a deferred tax asset or not, this amending standard would be very useful and clarify a number of aspects. The next standard that I want to look at is AASB 2016 number 2, and it's the Disclosure Initiative Amendments to AASB 107, which is the Statement of Cash Flows. Now, what they've done in this amending standard is they've added an additional paragraph to AASB 107. They've added paragraph 44 capital A. So if you want to know which paragraphs have been added after the standard has originally been issued, as soon as it's got a capital A or a capital B or a capital letter after the number, it's been an amendment since issue. Now, this paragraph reads as follows. It says, an entity shall provide disclosures that enable users of financial statements to evaluate changes in liabilities arising from financing activities, and including both changes that arose from cash flows, but also non-cash changes. So if we've had changes in liabilities, we want to understand why is there a change. Is it because we've repaid a liability, therefore it's a cash flow change, or is it because we've obtained more cash on loan or from a bank loan, or is it non-cash changes? So this is additional disclosures. So the additional disclosures include changes from financing cash flows, changes from obtaining or losing control of subsidiaries or other businesses. It could also be changes as a result of changes in foreign exchange rates. It could be changes in fair values. So we have to really disclose why do we have this change. Now I'll give you an example. This is an example disclosure. So potentially you would say my total liabilities from financing activities there's changes in long-term borrowings, there are changes in short-term borrowings, there are changes in lease liabilities, and there are assets held to hedge long-term borrowings. And if you look at the very first column in year 1 and you compare it to the column in year 2, you can see there's been changes. But now we have to break the changes down into which of those changes were as a result of a cash flow and which of it resulted as a result of non-cash changes. And the non-cash changes could be acquisition, it could be a foreign exchange movement, it could be a fair value change. So really more information on why do we have this change So additional disclosure is required. The third amending standard that we'll be looking at is AASB 2016 number 4, recoverable amount of non-cash generating specialized assets of not-for-profit entities. Now, first of all, why was this amendment required? Now, the amendment was required to address the uncertainty and again the divergence in practice around whether depreciated replacement cost, which is referred to in AASB 136, impairment of assets, and current replacement cost, which is included in AASB 13, fair value measurement, mean the same thing in the context of a not-for-profit entity. So this is really an amendment aimed at not-for-profit entities and saying, so depreciated replacement cost, current replacement cost used in two different standards. Are they different? Are they the same? If they're different, how are they different? So those were the questions floating about. So how does impairment testing currently work for not-for-profit entities? Now, if you do impairment testing for not-for-profit entities in AASB 136, you would say that recoverable amount is the higher of fair value less costs of disposal. And when you measure a fair value less cost of disposal, you would go and look at current replacement cost as defined in AASB 13. You will then compare fair value less cost of disposal with value in use, because the higher of the two will give you recoverable amount. And value in use would, in AASB 136, refer to depreciated replacement cost. So you will measure value in use using depreciated replacement cost, and the question is it similar or the same as current replacement cost under AASB 13? Are we expecting to see two different numbers here? So this amendment actually amends AASB 136, the impairment of assets standard, and it says that not-for-profits that is measuring specialized non-cash generating assets using the fair value model are no longer required to perform impairment testing under AASB 136. It also says that depreciated replacement cost, a DRC, under AASB 136 and current replacement cost, CRC, under AASB 13 are considered to mean the same thing. It also clarifies in paragraph OS 5.1 that you'll be ignoring disposal costs when determining the fair value under AASB 13, because not-for-profit assets are not primarily held to generate, this is not-for-profit assets not primarily held to generate cash flows and are rarely sold, and therefore disposal costs typically are negligible. So that's the reason why they said we could ignore a disposal costs. They also simplified the AASB 136 requirements for not-for-profits by deleting a number of paragraphs, and they also said if you're using the cost model, you will assess impairment testing using the current replacement cost under AASB 13 to determine recoverable amount. So the big thing here is that the AASB came out and said for not-for-profit entities, we consider depreciated replacement cost and current replacement cost to mean the same thing. Our last amending standard to consider today is further annual improvements, the 2014 to 2016 cycle. And this is around disclosure of interests in other entities, which is covered off in AASB 12. So as you know, when the AASB issued the new AASB 10 consolidated financial statements and the new AASB 11 for joint arrangements, they also issued AASB 12 addressing the disclosure requirements of all subsidiaries, investments in associates, joint arrangement, and all other interests in other entities that are included in consolidated financial statements. So AASB 5 in paragraph 5B provides relief to an entity with a non-current asset held for sale or a disposal group from disclosures in other standards that relate to those assets, unless those other standards specifically require disclosures. Now, this amendment clarifies that the only disclosures in AASB 12 that can be omitted under this relief provided in AASB 5 are those required by paragraphs B10 to B16 of AASB 5, of AASB 12. And that is summarized information for subsidiaries, joint ventures, and associates. So it's really saying if you want to use the relief in AASB 5, paragraph 5B, the relief only applies to AASB 12, paragraphs B10 to B16 around the disclosures for about interest in other entities. So what will that mean? Changes may require entities to include information about significant judgments and assumptions in determining control, investment entity status, information about non-controlled interest, information about consolidated structured entities. A retrospective restatement would be required and no transitional relief are available on that one. So in the first part of this webinar, I tried to deal with the mandatory changes for 31 December 2017 coming out of new accounting standards or interpretations, and it was only 4 amending standards. For the rest of the webinar, I'm more going to focus on hot topics and issues that are live at the moment. Some of them came to the front of mind during the 30 June 2017 reporting season. Some of them are as a result of regulatory changes, and this particular one is as a result of ATO guidance. Now, as you know, if you look at, there was a tax law amendment, and it's around combating multinational tax avoidance, and this bill came in 2015. So it's around general purpose financial statements for multinationals that have to be lodged with the ATO. Now, if these multinationals have to lodge general purpose financial statements with the ATO will then make those general purpose financial statements available to ASIC, and ASIC will place it on the public record. So this could mean a big change for a number of entities that, one, are currently potentially not lodging financial statements with ASIC, and therefore their financials are currently not on the public record. And 2, it could mean changes for entities that are currently providing special purpose financial statements to ASIC. So the bill amended the Tax Act, and it happened in December 2015, and it requires significant global entities, and there's a definition on what is a significant global entity, to lodge general purpose financial statements with the Commissioner of Taxation if the Australian subsidiary does not already lodge general purpose financial statements with ASIC. So the purpose of the bill is to find out if multinationals are paying enough tax in Australia. Now, you can see that a big thing here is what is a significant global entity. Now, if an entity has a global parent entity with annual global income of more than 1 billion Australian dollars, or the entity is a member of a group of entities consolidated for accounting purposes, and one of the other group members is a global parent entity with an annual global income of more than 1 billion Australian dollars, you've got a significant global entity. You have to remember, obviously, we're not capturing all global entities. It's global entities that has an Australian presence. And these changes became effective for income years commencing on or after 1 July 2016. So we're talking about 30 June 2017 year ends, and therefore also all the year ends coming up after that, whether it's 30 September 2017, 31 December 2017. Now this is something that definitely is on the radar of a number of entities at the moment. In IFRS advisory at BDO, we've been swamped by queries coming through our transfer pricing partners, our tax partners, business services partners. You know, everybody's talking about this, and what does it mean? So the ATO also issued some guidance recently to clarify a number of uncertainties. Before I look at that, which entities will be impacted? If an entity lodges general purpose financial statements currently with ASIC, there's no impact. But as you know, most entities, based on recent research issued by the AASB, most entities who lodge financial statements with ASIC actually lodge special purpose financial statements with ASIC. And if they are if they are a significant global entity or part of a group that has significant global entities, they will now have to lodge general purpose financial statements with ASIC. Also, there's a group of entities who does not lodge financial statements with ASIC. One reason could be because they are large grandfathered private companies. They, in terms of this Act, will now have to lodge general purpose financial statements with the ATO, which will be made available to ASIC. And then small foreign-controlled private companies that are applying the old class order 9898 will also be captured. That class order will not overrule this tax law amendment, and they will now have to lodge general purpose financial statements with the ATO and therefore with ASIC. Some entities who currently lodge special purpose will have to upgrade to general purpose. The other question that we've been asked is whether it's acceptable to lodge general purpose financial statements Tier 2, which means reduced disclosure requirements. That would be acceptable. It's not saying general purpose financial statements Tier 1. It can be Tier 2, therefore RDR. Do you have to lodge audited financial statements with the ATO? Because you know at the moment, if you have to lodge with ASIC, it has to be audited. If you're lodging general purpose financial statements with the ATO, does it have to be audited? There's no formal requirement for it to be audited. However, the tax office did say we would like to be able to rely on the financials. It has to be high quality financials. I actually think you know, without mandating audited financial statements, I think audited financial statements would be highly recommended from our perspective. The next thing I want to talk about is a recent change that came out of an IFRIC, the International Interpretations Committee agenda decision, and it's around deferred tax accounting for indefinite life intangible assets. Now, AASB 112 income taxes, and we seem to talk about this standard a lot today. This standard does say when you think about recognizing a deferred tax liability or deferred tax asset, if you've got temporary differences, you have to consider, does the entity expect to recover your asset or your asset through sale or through use? Because if you're going to recover the asset through sale, there could be a capital gains tax implication, and therefore that would impact your tax base and your tax rate. If you expect to recover this asset through use, the tax base will be different to the capital gains tax base because it's now an amortizing tax base. What amount will you be able to deduct for tax purposes as amortization or depreciation as you use the asset, and it might have a different tax rate. So the entity has to consider, how do I expect to recover the asset? And this expectation is a matter of judgment. AASB 112 then also clarified that if you've got a non-depreciable asset, and by that they were referring to land and specifically mentioning land in paragraph 51B, they said deferred tax is calculated based on the tax consequences arising on sale. So you've got an asset that you don't depreciate. When you want to work out the temporary difference and the deferred tax implications, you're making the assumption you're going to recover the land through sale. The question now, and now bringing it back to indefinite life intangible assets, the question therefore is an indefinite life intangible asset a non-depreciable asset that's similar to land, which would therefore mean that deferred tax is based on the tax consequences arising on sale, and therefore no DTL will be recognized. So there's a number of assumptions you can see that leads to the fact that no deferred tax liability is recognized on this indefinite life intangible asset. So that's the question. Can we make all these assumptions? Is it appropriate to make all these assumptions? So let's look at an example again. So let's say during the current financial year, Company A purchased Company B's business, including all of its operations, stores and brand names, which it intends to use. Now, this transaction meets the definition of a business combination under AASB 3 business combinations, which means we'll use acquisition accounting, which means all the assets and liabilities of Company B's business will be fair valued. Now, as part of the purchase price allocation, the brand names are assigned a fair value of 500 million. Because remember, we have to determine the fair value of all the assets, all the liability of the business acquired. And brand names, this intangible asset, 500 million. Now, the carrying amount of the brand name in the books of Company B in their separate financial statements is 0. But remember, when we apply business combination standard, we can fair value those assets, and it's 500 million. Now, the tax base of the brand name is null if we make the assumption that we're going to use the brand name in our business. That's our method of recovery of this intangible asset. However, the tax base of this indefinite life intangible, the brand name, is 500 million if we're going to sell it in future. So the question here is, if we look at the tax base, we're going to use it, is different to the tax base if we're going to sell it. And remember, we said we have to apply our judgment. Are we going to use it? Are we going to sell it? Now, following that through, the carrying amount is 500 million. If we assume we're going to recover it by selling it, the tax base is 500 million, which means there will be no DTL. However, if we make the assumption we're going to use it in future, then the carrying amount is 500 million, the tax base is 0, we've got a deferred tax, a temporary difference, and there should be a deferred tax liability. So question is, are we going to book a DTL or not? What tax base are we going to use? And it really comes back to whether we're going to use this brand name in the business or whether we're going to sell it. Interesting to note, and AASB 138 says we have to assess whether we amortize brand names or not. And let's say we've made the assessment that this brand name has an indefinite life under AASB 138, which means it will not be depreciated under 138, but instead there will be an annual impairment assessment. So that's the facts. Now, the IFRS Interpretations Committee in November, around a year ago, clarified that an intangible asset with an indefinite useful life, similar to what we've got here, our brand name, is not a non-depreciable asset as implied by AASB 112. So really what they're saying, land in AASB 112 is a non-depreciable asset because it has an unlimited useful life. If you look at an intangible asset, if we come up with it is an indefinite life intangible asset and therefore we're not amortizing it, it's just because we don't know what the expected useful life is. We cannot determine the expected useful life. It doesn't mean it has an unlimited or an infinite life. And therefore, non-amortization does not necessarily mean that the entity will recover the carrying amount of that asset only through sale and not through use. So a lot of people said, if we've got land that we don't appreciate and therefore we make the assumption we only recover it through sale, if we apply that same logic to indefinite life intangibles, we don't have to book a DTL. And IFRS is saying that thinking, we want to clarify, is not correct. So really what it means is, in our first scenario, if we're going to recover the brand name through sale, it means that there will be no DTL because in our judgment, the carrying amount is 500,000. When we sell it, we'll have a tax base of 500,000. We'll be able to deduct no temporary difference, no deferred tax liability. However, now that we have to make this a judgment and we can't just use the land rule in AASB 112, if we make the judgment that we're going to recover this indefinite life intangible asset by using it in our business, management expects to hold and consume it over the next 20 or how many years, we will have to book a deferred tax liability because now we'll have a carrying amount of 500 million, a tax base of 0 because there's no future depreciation for tax purposes, and therefore we have to book a deferred tax liability. Now there's a third scenario, and that is that there could be a dual manner of recovery, and you have to try and allocate which part will be recovered through use and which part through sale, which is highly judgmental and a complicated calculation. I think the point I want to make is it's really important if you've done a business combination where you've acquired an indefinite life intangible and maybe you've not booked a detail on that, that accounting treatment has now been clarified and we'll have to fix that and we'll have to correct that in the 31 December 2017 financial statements or as soon as possible. So if you've done a business combination, you have to think, did I acquire indefinite life intangibles? Did I book a deferred tax liability? Should I have booked a deferred tax liability and correct that? If another deferred tax question, we're really busy with tax today, is around deferred tax accounting for R&D incentives. Now this is an interesting one where I was speaking with our R&D partner in Melbourne, and as we were talking, we thought, oh, there are some interesting things we should consider here. Now, an entity, there are new research and development incentives available. So an entity must, under this new regime, an entity must register its research and development activities with Innovations Australia. And effectively, this is a rubber stamp process. You register. Once you've registered, you get it's like you apply for an R&D concession, and that application for your R&D concession is made on your annual tax return. Now, you have to be careful here that this application is, the details, etc., are noted on your tax return, but it's not part of your tax calculation. You don't get a tax deduction. It has no impact on the calculation of your assessable income on which you will pay tax. This is only if the company has a turnover of less than 20 million for a particular year. So instead of getting a deduction for these R&D expenditure through your tax system, instead you get a 43.5% non-taxable cash refund. So if your turnover is less than 20 million for a year, if you've registered, this R&D will not give you a tax deduction, but you'll get cash. and you'll get the cash at 43.5%, which definitely is beneficial in my mind, because I suppose most entity will be paying tax at 30%. So if you get a tax deduction, there's only a 30% saving, where here there's a cash of 43.5% involved. So once you've got this cash concession, you won't get a tax deduction on top of that. So that's just a new regime, and as I said, only if a company has turnover of less than 20 million. So in a little example, let's say you've spent $100 on research and development. Let's say you've capitalized it. It was development cost. It qualified to be capitalized under AASB 138. Your asset is $100. Your R&D concession received in cash was $43.50. And now at the end of the year, you've got a net asset of $56.50. So you can see I've made the assumption when I get that refund, I've offset it against my asset. I didn't book it as a separate income. So if we now look at this, the question really is, when you do your deferred tax calculation, you compare the carrying amount of your asset with the tax base of the asset. You think about it, what is the tax base of this R&D asset? The tax base is zero, because you're never going to get any tax deduction. You already got your refund, no tax deduction. So you've got an asset with a carrying amount, and you've got a tax base of zero, in my example. So the question here is, and this is just the definition of a tax base of an asset, the question is, should we be booking, therefore, a deferred tax liability on this particular asset? Now, there's an initial recognition exemption in AASB 112, paragraph 15, and it says that a deferred tax liability shall be recognized for all taxable temporary differences, except to the extent that the deferred tax liability arises either from the initial recognition of goodwill in a business combination, or the initial recognition of an asset or a liability in a transaction, listen carefully, which is not a business combination, tick for our situation, and at the time of the transaction affects neither accounting profit nor taxable profit or tax loss. And in our situation, I would tick that one as well. And therefore, at the time of that transaction, there's no impact on accounting profit. There's no impact on the tax calculation, and therefore we could use the initial recognition exemption, and we should, in this situation, not be booking a deferred tax liability in respect of this R&D asset. Now, divergence in practice is a lot. Some people have been booking a detail on the difference between the 100 and zero. Others have been booking it on the difference between $56.50 and zero, and others have not been booking it. So we believe it's the initial recognition and you should not be booking it. Please note that this only applies to a company with a turnover less than 20 million, and if you've registered your R&D activities with Innovations Australia, and therefore you're getting this cash refund and not a tax deduction. So there are a few hurdles before this would apply. Before we move on, I thought at this stage it might be time to just ask you a question around the poll, and if we can just I thought it would be interesting to see whether you currently receive a non-taxable R&D refund or incentive. I just wanted to see to what extent this would be within our client base, and to what extent this would be relevant. As you are aware, in these updates we address a number of things that we've picked up during the last number of months. Not all of it would impact everybody, but we do want to get the message out there. So at this stage, nearly 50% of you have voted. It would be interesting to see if more of you could vote, please. I'm trying to get to a 50% voting, and then we can release our results as scientific research on a webinar. So at this stage, just over 50% of you have voted. And I'll close this one and I'll share the results. In that 13% said this is potentially an issue for us, and I would say you might need to do a careful consideration of whether you should book a DTL or not, whether you qualify for the initial recognition exemption or not. As you know, there's a number of hurdles to jump. 73% says no, don't have to think about it. 14% unsure. So again, a little bit of homework for those people to think about. The next one is the change in the tax rates. Now again, the tax cuts were passed through Parliament and therefore substantively enacted in May. And the corporate tax rate will now be 27.5% if you meet certain threshold or hurdles again. So if companies are carrying on a business with a turnover not exceeding 10 million, and the income tax year ended on 30 June 2017, they could apply the 27.5%, and then, you know, it increases, or I think the applicability potentially increases if your turnover is less than 25 million for 30 June 2018, less than 50 million for 30 June 2019, this new corporate tax rate would apply to you. So this is again a tax change, but what does this mean for the preparation of financial statements? It means that if you apply for those amended tax rates, it will impact your current tax expense and current tax payable in the year it becomes effective, because you will now be paying at that rate, the 27.5% instead of 30%. But the big change from financial statement perspective is your deferred tax calculation, because your measurement of your deferred tax assets and/or liability should be based on the rates expected to apply in the period the asset is realized or the liability is settled. So if we think this liability will be realized, or this asset will be realized or the liability settled in a year that we expect this tax rate, that would impact the calculation of our deferred tax asset, deferred tax liability. So again, something to consider if you're in that bracket. Transition to the triple threat accounting standards and AASB 1058. So for for-profit entities, we're talking about AASB 9, 15, 16, and for not-for-profits, we're talking about all four. So this is for-profits. You can see two of them coming into play 1 January next year, leases 1 January 2019. For not-for-profits, there are 4 new standards, and AASB 16 have some nasties around peppercorn leases. But for not-for-profits, the main one that comes into play 1 January 2018 is AASB 9 financial instruments, and the other 3 1 January 2016. I just want to flag that when we look at disclosure in 30 June 2017 financials, we are very close to application date, mandatory application date. AASB 108 paragraph 30 requires an entity to disclose the fact that there's a new Australian accounting standard that's been issued. We haven't applied it yet because it's not effective yet. However, there is that standard. And then we also have to disclose our known or reasonably estimable information on how would that standard impact our financial statements. Now, for 30 June 2017, we haven't seen a lot of people actually provide numbers or descriptions on how these standards will impact their financial statements. I think a lot of people still went with, you know, we haven't done an assessment yet. But this raises a concern and a question. We're so close to implementation date that, you know, we have to start to get a grip on what this means for our organization. So for 31 December, again, I think we're running out of excuses and we're running out of time to make this assessment and this disclosure. So again, I thought it would be interesting to see what your experience has been. And I just want to check my expectation maybe with yours. So my question is, have you started your assessment of the potential impact of these triple threat standards? And this would be really interesting, and to compare what you have said with what I've seen. Maybe you've done the assessment, but you haven't included the disclosure yet. Maybe you've done the assessment and you intend to include a disclosure in the 31 December financial statements. So again, it would be really interesting to see how people are voting on this one. If a few more people could vote, that would really help us. We had 43% of you have voted. I don't think that's statistical research yet. We have to give get a big enough sample. Really interested in your views. All right, so this is very interesting. So we are at 49% of people have voted. Now we're over 50%. Right, very interesting. And that is that 44% of people have started, and I would like to congratulate them on starting this process on how would it impact our organization. The question is, have you also disclosed that? And then 39% said, no, we haven't. I think it's time to start. And 17, not really sure. So really important that we make an assessment, we're close to the mandatory application date, but also the fact that we have to disclose this in our financial statements. It's an ASIC focus area to look at these disclosures. The last thing is around the disclosure initiative, and we've talked about this many times, that the AASB would like us and has given us permission to focus on useful information in financial statements, and therefore we can remove a number of disclosures that are not material. We could reorder, we could regroup, we could re-emphasize. ASIC's view, they've also said, listen, we focus on material disclosures, and we would like you to declutter financial statements. The International Accounting Standards Board have issued, as part of that project, another document which is an IFRS practice statement 2, making materiality judgments. And this is to help users, this is to help preparers of financial statements to decide which information and disclosures would be a material disclosure that would have to be included, and which would be immaterial, and therefore I can remove it as part of the decluttering process. In our experience, most entities don't want to declutter, don't want to remove, because they're not sure that whether it's material or not. They don't want to remove and then be criticized for removing it, and then maybe next year they have to add it back in. The reason for decluttering is there's so much information in financial statements that it, that it's maybe hiding important information. So this is another interesting document that's available to help you on how do we determine, how do we make that judgment whether it's a material disclosure or not. So in our session, I think we've spent most of the time talking about tax, changes in tax rates, talking about deferred tax, because most changes have been in that space at the moment. If you need any assistance, please feel free to contact us. As you know, we've got webinars, we've got videos, we've got newsletters. You can link with BDO in Australia, our company website or LinkedIn profile. You can also link with me personally. Our IFRS advisory team at BDO, we're extremely privileged to have a huge team within Australia, with a lot of people spread across Perth, Brisbane, Melbourne, Sydney, Cairns, Darwin, Adelaide, Hobart. So if you're looking for advice, please contact us or contact your BDO contact person if you want to speak to us, and we're ready to help you with any of these matters. So any questions, please send them through. Thank you for joining me for this webinar. I'm quite surprised I'm running only 4 minutes over time. I expected to run a lot more over time, and I hope to speak to you again next month on our final webinar for this year. And very soon we'll release the schedule for next year. because we've got the triple threat accounting standards and AASB 1058 coming in. There's a lot of work to do, and we'll have to investigate a lot more, and we'll keep up the webinars and the training. So thank you very much. I hope you have a good day, and we'll speak soon. Thank you.